Well, hello everybody. My name is Mark Negrini. I'm the author of Forensic Analytics, and this is a critical review of the quarterly results of Snap for the second quarter in 2020. Snap is the creator and the owner of the social media app known as Snapchat. We will briefly look at remuneration, insider trades, the stock price, and then we'll have a more in-depth look at the financial statements. And I'll close with a note about the tone at the top and some conclusions. So, where do I get my quarterly data from? www.sec.gov. On the top right, click on Company Filings, enter Snap, click here, and then we'll get to all of Snap's filings. You can type in 10-Q over here, click Search, and you should get all the quarterly reports. If you want the annual reports, it would be 10-K. So, let's have a look at executive compensation. This is the compensation for 2019, 2018, and 2017. As we can see from this, the executives are well paid and they have a real vested interest in the success of the company. We will see in a moment that we'll have a look at the 2019 results, and I do believe that that salary was indeed, based on the 2019 results, way too high. Employee, our median employee, annual total compensation $305,733. Now, this means that half of the employees earned more than $305,733, and half earned less than $305,733. This is high. Let's do a comparison. Snap, right at the top, $305,000. Microsoft, with highly skilled employees, $172,000. Twitter, highly skilled employees. Facebook, highly skilled employees. Google, highly skilled employees, coming in at $259,000. The median employee pay is extremely high. Insider trades for the past year: shares bought, shares sold. Net sales, about 20 million shares, and I really can't blame the executives here. I too would want to diversify my portfolio, and 20 million shares based on their total ownership is a low percentage. Let's have a look at the stock price. Started off on going public in March of 2017 at about $26 per share was the close for the first day. It's been a rocky road down to the doom and gloom of early 2019 when the stock price was trading at just a little over $5 per share. Then it was a rocky ride up, and we are now at about $22.50 per share, giving the company a total market capitalization of, call it $33 billion. So, let's see whether it is even remotely worth $33 billion. The most recent quarterly reports from 10Q, they start with the statement of cash flows. They're unique in that not many companies use that as their first statement. I had a close look. Everything looked normal, except when it went to the bottom and I saw cash flows from financing activities. Purchase of capped calls, $100 million. And essentially, these are call options, and it is there as a sort of insurance policy to make sure that when the company's notes mature in 2025 and 2026, that the note holders don't make an exorbitant profit on conversion at the expense of the current shareholders. So it's a little insurance policy against them making out like bandits in the event of an extremely high stock price. I believe this is simply related to the cost of the notes themselves. Now, we have the 100 million. It's always going to be a credit to cash because 100 million went out the door. But what do we debit? If we see this as a cost of the notes, we will debit interest expense and we will amortize it over, let's say, 5 years, 20 million per year. What they did, though, was a straight debit to additional paid-in capital of $100 million. In this case, it'll end up being a debit to shareholders' equity, but it'll go through the income statement and it'll end up reducing retained earnings, but this company has no retained earnings. It'll end up increasing the accumulated deficit by $100 million over 5 years. They did the debit to additional paid-in capital right now, bypassing the income statement. And we can see that this is exactly what they did. Additional paid-in capital, opening balance, adjustments, and here the 100 million gets lobbed off, giving a balance end of period 9.7 billion. This treatment has been done before. You can do a little search on the SEC's website, Edgar, Salix Pharmaceuticals, and they did the same thing, but this was a 4-page explanatory letter justifying their treatment of doing this. It's a clever move, and it is one that is income increasing to the tune of $100 million over the next 5 years. Now, October 2018, this memo became public. Spiegel said, our 2019 objectives and key results, full year profitability. So this is 2018 and he wants 2019 full year profitability. And this is a more detailed excerpt from the same memo. Our 2019 stretch output goal, full year, free cash flow and profitability. Let's see what they did in 2019. This is the income statement for the year. Revenue, total costs and expenses, net loss, $1 billion. In other words, his goal is profitability. He loses $1 billion. And it was with a fair amount of shock that on all the earnings releases, I never once heard any analyst use the word incompetent or negligent. Your goal is profitability, you lose $1 billion. How bad is this? I looked at CompuStat. I extracted all the net incomes for the United States listed companies. Snap, remember I used the first one as headings, 33rd. It was the 33rd worst loss for a company in 2019. Your goal is profitability and you make the 33rd worst net income. Retained earnings, 27th on the list, with negative retained earnings, an accumulated loss deficit of $7 billion. Well, let's look at the latest 3 months. Revenue, 454 million. Operating loss, net loss, 325 million. Now, the question beckons as to whether this number is overstated. The loss is lower than what it should be. Well, the way that you can carry this out is by inflating revenue. And the way that you would inflate revenue is by debiting accounts receivable and crediting revenue, and I just made up a number here of $2 million. Let's see whether this is likely, and we will look at it from 2 points of view. First, accounts receivable. Total revenue, days in the quarter, sales per day, $5 million. This is their accounts receivable, $379 million. If I divide it by the sales per day, I see days of sales outstanding, 76 days. On the face of it, this might seem high, because if I look at their terms, you agree to pay all charges within 30 days. Let's have a look at the 76. Let's assume a hypothetical advertiser. At the beginning of month number 1, they start running an ad and they run it all the way to the end of month number 1. Then they get billed, and then they have 30 days in which to pay. This very last penny over here, outstanding for 30 days. The very first penny outstanding for 60 days. On average, outstanding for 45 days, and they are still within the terms allowed. So, this is 31 days more than the company's terms. It seems high. However, that said, it's been even higher. When I did the calculation for the end of 2019, it turned out that they had 103 days of sales outstanding. In other words, more than 1 quarter outstanding, and so they've come down from 103 days to 76 days, and this at least makes me think that the accounts receivable number is not overstated. Sales, are they overstated? Let's have a look at the revenue per employee. Total revenue, number of employees, revenue per employee for the quarter, and I annualize it by multiplying by 4. Revenue per employee for the year would work out to 511 million. Oops, not 511 million, just 511,000. Let's do a comparison. Snap, revenue per employee, 511,000. Twitter, a little bit more. Microsoft, much more, not quite double, but much more. Google, 2.5 times as much. Facebook, almost 3 times as much revenue per employee. In other words, they're at the bottom of the pile, and this suggests to me that revenue isn't overstated. As a reminder, when it comes to revenue per employee, they're at the bottom of the group. When it comes to median employee pay, they're at the top of the group. These two don't go well together. Now, let's have a look at the net asset value per share. These are the assets. If we sold all these assets at the book value, we would get $4.7 billion. But we wouldn't have the whole $4.7 billion. We would have to pay the liabilities of 2.5, leaving us with stockholders' equity, the number of shares outstanding, and if I divide the one by the other, net asset value $1.49. So if I liquidated the company, sold the assets, paid off the liabilities, each shareholder would get $1.49 per share. By the way, the shares outstanding come from a strange place. It's the first page of the 10Q at the bottom. All companies put it over there. So this is from first page of the 10Q right at the bottom. We would only have $1.49 per share per shareholder if things got liquidated. There's one asset that is missing here, and that is the deferred tax asset of 1.8 billion. However, that asset is only really an asset if you see yourself making profits into the foreseeable future. Now, another way to calculate the net asset value, you can simply go to the balance sheet, take total stockholders' equity and divide it by the number of shares. So here we have it. Net asset value $1.49, stock price $22.50. We're expecting the $1.49 of assets to generate enough profits to justify a stock price of $22.50. It's rather strange, but if you wanted to justify this stock price of $22.50, the company would have to make about $1 billion. $1 billion of profit would put you fair and square with a fair market cap of $22.50 per share. That works out to about 75 cents per share. So I'm actually expecting this $1.49 to generate 75 cents per share to justify this stock price. Just as a matter of interest, when the company went public, it went public at $17 per share. So those investors paid $17 per share way back in March of 2017. They paid $17 per share. What's left of the $17? $1.49. In all fairness, some of the other investors paid much less than $17. Some of them would even have paid less than $1.49. Now, are they stretching things? And we can tell from this that I think they're not stretching things, and I don't blame them for not stretching things. If you stretch things this quarter, it just makes it harder to look good next quarter. Non-GAAP, reported net loss, they make their adjustments, and they get a non-GAAP net loss of 124 million. We divide it by the number of shares outstanding, and we get a loss per share of 8.6 cents. They then take this 8.6 cents and they round it up to 9 cents. And this was what Wall Street was hoping for. So they take minus 8.6 cents and they round it up in the direction away from where they would like it to 9 cents. If they had made just $1.6 million more and the loss was less, they would have earnings per share coming in at less than 8.5 cents loss, which they could have rounded down to 8 cents, and they could have put a number there of 8 cents. However, they didn't do this, and this suggests to me that they're not stretching things, at least not as much that I can notice. Here's a little trick. When you're making a loss and you divide by the number of shares, the more shares you have outstanding, the lower the loss per share. So I just made up another number, 1.5 billion, it's a little bigger than that. Earnings per share, 8.29 cents loss. This would be rounded down to 8 cents. So when you're making a loss, the more shares outstanding, the lower the loss per share. And that is good. However, it comes back to bite you. Once you start making a profit, the more shares outstanding, the lower the earnings per share, and now it's not working in your favor. A few more notes. Just a note here about the tone at the top. August 2017, after a disaster quarterly report for the second quarter of 2017, Snap co-founders will not sell shares. Bobby and I will not sell any of our shares. August 2017. Same date, August 2017, agreed not to sell any shares this year. December 2017, Spiegel sold $10.1 million worth of shares. When it comes to the tone at the top, the only 2 points I want to make is when you say something, you need to mean it. And when you say something, you need to remember that you said it as well. If you want more information, investor.snap.com. Most companies have got an investors tab. You can click on it, you can click on the events, click on the plus sign, and you'll have almost everything there that you could hope to see. So, the conclusion. The stock is richly priced. The market cap is $33 billion. In order to justify this and get a same valuation as Google, Facebook, Microsoft, this company actually needs to be making $1 billion of profit per year with some growth forecast into the future. They are nowhere near making any profits, let alone $1 billion worth of profits. So, these are their headlines. This is what that stock price is based on. Revenue increased 17%. Daily active users. Adjusted earnings before income tax and depreciation allowance of about a negative 100 million over here. These three metrics are driving that stock, that richly priced stock price. I believe the valuation is rich and the shareholders are very brave, because we're looking at another loss again for 2020. I notice this is what they say during the earnings announcement. We continue to invest. We continue to invest. We strengthened. We continue to innovate. We added new tools. Here is the irony. The irony is that when they started as a messaging app. And all that it was a picture exchange, no messages. Then they moved on and they had message after message, and then they moved on to video. This part of the platform generates absolutely no advertising income, and it is all these extra things that is specifically designed to generate the advertising revenue to support, or how can I say, to pay for this. And this was the company's original mission and the company's original purpose. We need this to subsidize that, and this is indeed not doing it at the moment. A few more notes. This is very current for today. TikTok contributed 4.4% of Snapchat's ad revenue in 2019. Today's headlines. Trump says that he will ban the Chinese video app in the United States. If TikTok indeed gets banned, that 4.4% disappears, and we have a terrible loss to the top line. I can only believe that Snap would dearly love to buy TikTok. But if we go back to the balance sheet, we will see they don't have enough cash to anywhere near pay for the app of TikTok. I would almost guess that with TikTok has about 80 million daily active users. Market cap will be somewhere north of $5 billion. I think Snapchat would love to buy it. Snapchat does not have the cash to buy it. And indeed, I don't think Snapchat has the expertise to run TikTok. They hardly have the expertise to run their own app, let alone run somebody else's app and make a profit. So, those are my conclusions. I'll be happy to talk to you again in about 3 months' time when we see what the company does in the third quarter. Bye-bye for now.